Mohammad Apabhai, Head Asia Pacific Trading Strategies at Citi. Mohammad, hi, morning. First, your view on the rally that Indian stocks have seen. Too much too soon, or is it factoring in improving macros ahead?
Good morning, and thank you for having me back here again. I think what is going on right now is not just India-specific phenomenon. It's actually going on right across the world. Basically, what had happened was that markets were pricing in very close to a near-death phenomenon in September, October, November of last year. And with the ECB policy action and the provision of liquidity from the central banks, what markets have realized is that there is life in 2012, that the economic activity is not going to cease. And what we are seeing now is a normalization of market levels. I think we're almost at the levels where markets have normalized, and beyond this really will be the start of some sort of euphoric sort of buying, but we're not quite there yet. We still think that markets have got some way to go before they do normalize, but liquidity is the key thing here, and liquidity is being provided. And any time it looks like that liquidity isn't enough, they'll come back, and it seems like they're just going to provide more.
So around 5,400, do you think the market will consolidate further, correct in the near term, and then take that leap to the euphoric activity that you just spoke about?
Yeah, I think any consolidation that we get is going to be pretty limited. The point is that investors are still very underweight in equities. They're very underweight in risk in general. And that is going to continue. If you look at money market balances, the amount that people still have in cash, still running very high levels. People are still parked in bonds where the carry is actually negative, real rates are actually negative. And over time, as they become more comfortable with the risk environment, I think there is still more money that is going to transfer from the safety trades into the higher risk trades. And India, as part of the emerging markets, is a key beneficiary of that, as are all risky asset markets. I think for India in particular, it had been so heavily sold down that it's actually got more way to go in terms of normalization.
Mohammad, so do you feel that for India, a new bull market has started? India, which was a sell on every uptick market for the year 2011, is now a buy on every decline market?
Yeah, I think the market psychology has completely changed. I mean, one of the problems for India in 2011 was the outlook for inflation. Certainly with the crisis that we had in the third quarter of 2011, the inflationary expectations have got completely squeezed out of the market. In fact, what the RBI is now moving towards is something which is a far more dovish, far more accommodative sort of stance. And that is the environment which the equity market in particular loves. In addition, I think some of the funding problems for Indian banks will be relaxed as well as the RBI provides them with additional liquidity. With the industrial production numbers having fallen so sharply, there is a limit now to how long the RBI will keep tightening policies in place. And it's not just in India that we're finding this, but actually on a regional basis, whether you're looking in China, Korea, Japan, Taiwan as well, it's pretty much the same sort of story, that the tightening policies for 2011 have worked. Inflation is now seeming to be under control under the current market environment, and that will allow policymakers, if not to reduce policy rates, at least to keep them on hold for the time being. So a major concern for Asian equity markets does seem to be out of the way.
Mohammad, post the passing of the austerity bill in the EU, how does the liquidity landscape look at in general? Will the surplus funds keep finding their way into emerging markets, at least in the near term?
My view is that yes, they will. There's a few things that are going on. First of all, if you look at money market rates, especially dollar funding rates, have come down quite a lot. They're almost on the brink of normalization. Equity implied volatility is almost on the brink of normalization as well. And a large part of this rally appears to have been triggered by the ECB LTRO, which happened in December. Now, what is very interesting is that the LTRO was about 489 billion euros, which is almost the size of QE2. But the difference was that QE2 was spread over an 8-month period, whereas the LTRO program from the ECB was basically a one-off hit. And what we are seeing is that all that money that is coming into the markets is basically driving us higher. Now, the estimates for LTRO2, which is going to be happening on February 29th, vary. It's anywhere between 400 billion euros to up to 2 trillion euros. Now, the actual amount I don't think is as significant. What is significant is that A, this money is going to be coming in. B, the market still is very underweight for risk. And C, I think before the end of the quarter, what you could potentially get is very much a benchmark chase. Now, the other possibility as well for additional provision of liquidity could come as early as today. We do have a Bank of Japan meeting, and the yen is very strong. Now, one thing that is interesting is that now if you get a very high number for the LTRO programs from the ECB, basically the Fed and the ECB will both have done between $2 and $2.5 trillion of QE. The Bank of Japan is lagging far behind. So whether they come out and do something, or whether there's some intervention in the currency, as the finance minister has been talking about, that will be an additional additional provision of liquidity from the central banks.
Right. So, Mohammed, oil-rich Arab zone is sort of simmering again with geopolitical tensions as well, and crude oil has already bounced back above, the 118 to a barrel mark. How does the scenario look on that front, A? And also, can a rise in crude cause a shock to India, which is heavily dependent on imports?
Yeah, I think that's a very good question. I think that it really depends on what your outlook is for geopolitical tension in that region. I mean, obviously, it makes people feel very uncomfortable. It's a very volatile part of the world. Everybody knows the crucial role that Iran plays in this. At the moment, the markets seem to be taking the view that this is a lot of political posturing. There are elections in Iran coming up. I believe in the next couple of months. It could just be political posturing. The rally that we are seeing in oil doesn't seem to be over and above anything else that we are seeing in any of the other equity markets. So it's not like oil is up 25% while the rest of the other markets are up 5%. The other thing is that the other OPEC members have guaranteed production. So in terms of a disruption in terms of oil supplies, it doesn't seem that the market is particularly concerned about that as a near-term phenomenon. But it's certainly something that we are continuing to watch to see if the pressures do ratchet up. And of course, for India in particular, oil price sensitivity is a pretty significant factor. I suppose the only redeeming feature has been that the Indian rupee has appreciated by so much that it's really taken the edge off the oil price rise. And I think in rupee terms so far this year, the oil price has actually been on a decline rather than on a rise.
So, Mohammed, at Citi, for the year 2012, what is your big macro call? Invest in assets which will benefit because of a dollar appreciation or because of a dollar decline? Buy emerging markets or revisit emerging markets? What are your big calls?
Yeah. Well, I think the thing is this, that we're probably 2/3 of the way through the rally right now. As we all know, probably the best opportunities for buying this market have already gone. There is still fear out there. There is still the wall of worry that we are climbing. For example, whenever some big hurdle that the market has placed in the way, for example, the Greek vote over the weekend is out of the way, always you see somebody else coming in and saying, well, okay, that's out of the way, now there's another there's another problem that we need to deal with. Meanwhile, the markets continue grinding higher. My view is that what is going to happen is that any consolidation in this region is going to be pretty shallow. It'll probably be about 2 to 3%. And then we continue pushing higher, maybe about 7 or 8% from where we are right now. In that sort of scenario, all the other risky markets will continue following them to various degrees, driven by domestic liquidity concerns. And what you'll get right towards the end this time round is a huge amount of retail participation coming in right at the end of the rally. Now, this is very different to March of 2009, where we saw a lot of retail participation right at the beginning of the rally. So this is going to be fairly different in the dynamic. Now, there is potential for a very big burst of liquidity, given what is going on, to actually hit the Asian market. So we think that certainly on the trading floor side, that the Asian equity markets are likely to outperform the global developed markets, in particular the US equity market, in the next couple of months. The March quarter end will probably see a huge squeeze as funds that are underweight come into the markets and start buying. And we'd actually use the strength in late April at this moment is our thinking to start unwinding some risk into that. We think that at that point the value will all be gone, and we need to wait for probably quite a pullback to get us interested again as well. You know, the distance, we're climbing away from the area at which the central banks will be intervening. So for us, the trade at the moment is stay long Asia against the US, stay long into the end of March, into the middle of April, and thereafter start unwinding some risk into May, and go away, have a nice summer, and then come back in September when markets are probably at a much better level to buy into again.